without the need for long identity verification processes. But all traders are not the same, and there are different types of trading methods. For example, day trading involves conducting multiple trades throughout the day and trying to profit from short-term price movements. Day traders spend a lot of time staring at computer screens, and at the end of the day, they usually just close all of their trades. Scalping is a day trading strategy that a lot of people are talking about. Scalping attempts to make substantial profits on small price changes, and it's often referred to as picking up pennies in front of a steamroller. Scalping focuses on extremely short-term trading, and it's based on the idea that making small profits repeatedly limits risks and creates advantages for traders. Scalpers can make dozens or even hundreds of trades in one day. Meanwhile, swing trading tries to take advantage of the natural swing of the price cycles. Swing traders try to spot the beginning of a specific price movement and enter the trade. Then they hold on until the movement dies out and take the profit. They try to see the big picture without constantly monitoring their computer screen. Swing traders can open a trading position and hold it open for weeks or months until they reach the desired result. So now that you know what trading is, how is it actually accomplished? How can someone predict what Bitcoin will do? The short answer is that no one really can predict what will happen to the price of Bitcoin. However, some traders have identified certain patterns, methods, and rules that allow them to make a profit in the long run. People follow two main methodologies when they trade Bitcoin, or anything else for that matter: fundamental analysis and technical analysis. Fundamental analysis looks at the big picture. In Bitcoin's case, fundamental analysis evaluates Bitcoin's industry, news about the currency, technical developments of Bitcoin, such as the Lightning Network, regulations around the world, and any other news or issues that can affect the success of Bitcoin. This methodology looks at Bitcoin's value as a technology, regardless of the current price, and at outside forces in order to determine what will happen to the price. For example, if China suddenly decides to ban Bitcoin, this analysis will predict when the price will probably drop. Technical analysis tries to predict the price by studying market statistics, such as past price movement and trading volumes. It tries to identify patterns and trends in the price, which may suggest what will happen to the price in the future. Technical analysis assumes the following: regardless of what's currently happening in the world, price movements speak for themselves and tell some sort of a story that helps you predict what will happen next. So, which methodology is better? Well, like I said in the beginning, no one can accurately predict the future. However, a healthy mix of both methodologies will probably yield the best results. Now, let's continue to break down some of the confusing terms and statistics you'll encounter on most of the exchanges. Bitcoin exchanges are online sites where buyers and sellers are automatically matched. An exchange is different than a Bitcoin company that sells you Bitcoin directly, such as CoinMama. This type of company will usually charge a higher fee. An exchange is also different from a marketplace such as Local Bitcoins, where buyers and sellers directly communicate with each other in order to complete a trade. The complete list of buy orders and sell orders are listed in the market's order book, which can be viewed on the exchange. The buy orders are called bids, since people are bidding on the prices to buy Bitcoin. However, the sell orders are called asks, since they show the asking price that the sellers request. Whenever people refer to Bitcoin's price, they are actually referring to the price of the last trade conducted on a specific exchange. This important distinction occurs because there is no single global Bitcoin price that everyone follows. And sometimes, Bitcoin's price in other countries can be different from Bitcoin's price in the US, since the major exchange in these countries include different trades. Aside from the price, you will also sometimes see the terms high and low. These terms refer to the highest and lowest prices in the last 24 hours. Another important term is volume. It stands for the number of overall Bitcoins that have been traded in the given time frame. Significant trends are usually accompanied by large trading volumes, while weak trends are accompanied by low volumes. A healthy upward trend is accompanied by high volumes when the price rises, and low volumes when the price declines. If you are witnessing a sudden change of direction in the price, experts recommend checking how significant the trading volume is in order to determine if it's just a minor correction or the beginning of an opposite trend. So now you know most of the terms you'll encounter on the average exchange. It's time for us to move on and go over the types of orders that you can place on an exchange. There are three types of orders. A market or instant order refers to an order that will be instantly fulfilled at any possible price. So if you put a market order in to buy 5 Bitcoins, you will find the cheapest sellers possible until it accumulates enough sellers to hand over 5 Bitcoins. In other words, you might end up buying 3 Bitcoins at one price and the other 2 at a higher price. In a market order, you don't stop buying Bitcoin until the amount requested is reached. With market orders, you may end up paying more than you intended, so be careful. Meanwhile, with a limit order, you will only buy or sell